to do the 5 extra, as my father passed away. So.
All right. Thanks, guys, for joining us on this. Mike, what holiday is today? Is it President's? What is it?
Yeah, it's President's Day or something like that.
Yeah. We call it a W-2 holiday. My phone was, I guess the emails were slow, but the phone, we kept hammering it through. And you almost kind of start realizing who's really looking to get after it and who's looking for a little bit of a break. So we got a little bit of a special treat today. So this was supposed to be a Zoom on when to invest. So we'll touch slightly on that. And then we have the special treat is we're going to hit off with where to invest. So we'll go when to invest and then where to invest. And we actually have some very, very good data from a document from John Burns, which is probably one of the best SFR rental data sources anywhere. They have every single metric possible when it comes to rentals. And we have full documents of it, and we're going to share it with you. So it's a little bit of a special treat today that the information is actually quite rare and it's not published publicly. John Burns is not published publicly. It's only a subscription-based. It's a subscription-based service. So, okay. So we'll hit real shallow and then we'll go deeper. Like I said, guys, thanks for joining. We'll try to keep it probably about a half hour, maybe 40 minutes at the end. Ask a bunch of questions and answer a bunch of questions. And let me put myself here. Hold on one second. Good. Okay, so we'll answer a bunch of questions if you guys have any, and we'll wrap it up. So a lot of times we get asked, and let's start here. So most of you on the call know what I do. We do real estate syndication. We buy large multifamily assets in the Southeast. And a lot of times people ask me, what is syndication? How does this whole thing work? How do you guys manage it? That's probably the two biggest questions is what is syndication and how do you guys manage it from living in New York and New Jersey if you own properties in the South? So we focus on buying 100 unit plus assets in the Southeast, and in multifamily 100 units is the sweet spot. So that's the place that you get to where you start to get some large management companies. And Alex, my partner's on the call. He's in a bunch of deals with me in the Southeast. You start to hit a point where you get, we got some way to go, people. You hit a point where you buy over 100 units. You get a management company that is truly dedicated to your property at a whole other level. Accounting, property management, project management, full on-site staff. It's a whole other level. If we were to live in the area or live here, it absolutely makes no difference at all. And syndication is a process where we basically sell off 70% of the equity of the deal to investors. So we're bringing investments, we're bringing the ability for people to get in, everyday people to get into large multifamily, which is significantly less risky than small multifamily. If any of you have ever purchased 1 or 2 family houses, we know the whole thing. You buy a 1 family or 2 family house, 50% of it, you lose 1 tenant in a 2 family house, you have 50% unoccupied. So the higher unit count, the more stable the investment. We bring that opportunity to accredited investors. For people that make good money in what they do, they just don't have time to invest in multifamily. They don't have time to invest in real estate. It does take a tremendous amount of time to find good deals. For anyone who ever landed at a good deal, you know that it didn't happen very easily unless it was some kind of inheritance or something. And I'm sure there's probably some people who make very good money at what they do. They've half-assed the real estate thing and they've realized that all real estate isn't created equal. So we bridge that gap. And for the most part, we've seen that people who do not do real estate full time the earnings, 70% of the earnings of our deal will actually equal or beat 100% of the earnings of an asset that's not paid attention to. Whether it be you got into a bad deal or you're not paying attention to the operation and it's slipping and you're missing payments and you're spending too much on expenses, whatever it is, all of that we track very tightly. Okay, so when to invest. So there's two different brackets of investment. Some people come to me and they say, hey, I have $50,000 or $100,000 and we're looking to invest. Should we invest in a deal with you? And really, the answer is, it depends. Why does it depend? Well, what do you want to do with your life? That's always the big question. Do you want to make real estate a profession? Do you want to further your your career in this, or are you just looking to see your 50 or 100,000 or 200,000 double or triple? So if you're an individual who wants to see this business grow, the first $50,000 or $100,000 has to go into some level of education. You don't want to go from 50,000 or 100,000 to now $0 or $5,000 in your bank account and think you're making a good investment. You'll only do that if you're not interested in ever furthering your career in this, and you truly just want to get your money into someplace safe, like that money was either headed here or the stock market. You want to, it's a significantly better idea to put it into real estate. But if you're not looking to do anything further in this business and you're like, it doesn't pay for me to learn anything, then you would go more lean into investing 50 or 100,000 when that's the only capital. If you are looking to make this more of a job or profession for you, the 50 or 100,000 should go into some level of education. If you have $500 to $1 million and you're looking to get into some form of real estate, this increasingly becomes a better idea for you to invest with someone else who has tremendous track record and knows what they're doing and puts 100% of the time into it. Because a lot of times 500 or $1 million could go into some bad real estate that doesn't make much sense. So it really depends on where you are. Are you interested in growing, or you're interested in just keep doing what you do and not make much of a push into the business? The only reason you would get involved with a small investment in one of these funds, and it's not mine, it doesn't matter to me if you invest with me or someone else. There's plenty of real estate funds out there, and you should look at them all, to kind of educate yourself in the whole thing before you jump in with anybody. But if you're jumping in with a small amount into a fund, if you're looking to get into this as a business, is not a bad thing. Just so you could see how the reporting goes. And I've heard people say, when you pay attention. So by investing money, it'll definitely increase your senses into this, and you'll start to pay attention more, and you'll really start to learn it a little bit quicker. So that would be one small reason why you would want to get into this without having a tremendous amount of money behind you. Okay, and when to invest, the other side of it is, so that's personally, and then the market. As we all know, okay, so human instinct is to invest when everyone else is investing and sell when everyone is selling. For some reason, we're all wired the same. I have to fight this myself. When everyone else is selling, you're kind of like, should I get out now? Or when everyone's buying, all of a sudden, you're very interested to buy. You have to do the exact opposite of the way you feel. So period of time wise, just watching the news and watching how things are flowing, however you feel naturally, your human instinct, just do the exact opposite, and that will put you in the place to win that will put you in the place to be most successful in this business, like by far. So when everyone was in a frenzy the past 2 years and you felt like you had to buy, it was probably a good decision the past 2 years to not buy. Alex and I looked through a tremendous amount of deals, and at the extreme height of the market, we only purchased one large deal at the height of the market. Nothing else penciled, unless you really, really thought, unless you really, really put some numbers in your underwriting that you thought the real estate market was going to rip for another 5 to 7 years. Those are the people who bought over the past couple of years. And they're starting to see the pain now of interest rates starting to climb. The real estate purchased when everything was at emotionally the peak, is typically the worst time to buy. So now when there's everyone who's kind of concerned, and there's not as much attention. Alex and I were just on the phone with a broker earlier, and he said there's a whole bunch of chatter, but there's no one taking action. So our response was, this specific broker was in Dallas. After he said that, our response was basically, okay, we'll see you in the morning. We're booking a flight 5:30 in the morning tomorrow morning. We'll see you in the morning. So, when we start to hear that things that we're looking at were being looked at by national home builders a couple of months ago, and they decided to take a break for a minute, that turns us on, where most people would say, if other people aren't interested, we're not interested. So when to invest, now would be the time over, and we don't know if it's going to get much worse, right? But now would be a better time to invest than a couple of years ago or a year ago, say. We're gonna, and so what I could do now is I'll share some screens, and I'm going to show you the next thing is going to be where to invest, which is probably going to be the best part of the call. We'll run through some stuff, and like I said, we'll cut you loose. Alex, if you wanted to hit anything on that before I share the screen.
Yeah, no, I echo a lot about Chris had said, and we've continued to look at opportunities in real time. A lot of them just did not pencil with the increased cost in debt. Rents are slowing down a little bit in some markets, but yes, to Chris's exact point, land is dropping in price quickly, probably more quickly than any built product that we're seeing, just because different builders or developers, they're sitting on that land, their project or their expected project either is not penciling or they've been unable to raise the capital to execute it. So at this point, they may have spent money on soft cost, entitlement cost, zoning, engineering work, but they are actually eager to kind of pass that along to someone else, maybe make a quick buck or even sell it at par and move on. So, it's still very attractive land, very attractive markets. You're just seeing some guys that probably waited too long, maybe just want to dispose, without taking a bath on it or carrying this for consecutive months. So we're definitely seeing opportunity. And, as Chris mentioned, speaking to brokers day in and day out, we are seeing land costs drop drastically over the last 4 to 6 months.
Yeah, it's an interesting, a very interesting thing about the real estate market currently, and this is across the board. And we could see it definitely in the residential market, and we can see it in the multifamily market, where now would be a good time to buy because, the future is uncertain. The interesting part is in the multifamily market, what happens with uncertainty is people like, you know what, we're just not going to sell right now. If you search nationally for multifamily in good markets for sale right now, you're literally going to find deals that were live for the past year. You'll see if you've been in the market, you look at something, you're like, oh yeah, that deal's still for sale. That deal's still for sale. So it's interesting to see that now would be the time to buy. But just because a lot of assets are locked up into lower interest rate and the uncertainty that some guys are still cash flowing, people are cash flowing. The pain and hurt that we thought would come to the market hasn't really came to the market in the multifamily space. And in the residential space, for sure, everyone's locked up into long-term low interest rate debt. So even though the market might be uncertain or people, the future may be uncertain, everyone, what they're doing is they're just holding. And it's strictly because a big reason is everyone's locked up to the long-term low interest rate debt, and they don't have to move. People don't have to move for the most part. Sometimes people are in a position, random position, that they have to move, but the market is just frozen almost when it comes to already developed property. Land on the other side, land is a cash suck. So to hold land takes money. Land is completely non-revenue generating, and the uncertainty is actually now triggering sales. Alex and I are looking tremendously into land right now. A big thing, just so as a little insight into our life, where we're exploring, and we will be taking action on 100 unit plus development. So I never thought I would say that I'd be doing that, just because for us, it always made more sense to buy a deal that was alive already than developing. But we're finding tremendous opportunity to develop 70 to 120 houses in one shot. And we put it together as a package. We do a takeout loan, keep it, and rent the whole thing. So there's some metrics that we go through to meet that criteria, very specific metrics. It's actually very interesting. What's interesting about what we're doing now is we could talk about a deal for about a minute and a half. And in that minute and a half, say pass, pass, pass. That sounds attractive. Pass, pass. So we'll leave a phone call with a bunch of deals rip past us instead of having to underwrite all of them. We have to just hit a switch strict metric. And believe it or not, we find a lot of our information through Zillow. We just need to know what house prices are retailing for in the area, what they're renting for in the area, and we could quickly do a calculation. We know what it costs to put houses in the ground. When you're building spec, it's very easy to know how much the job will cost. As long as there's a couple quick questions we have to ask as far as, could we hook up the city utilities, water, sewer, power, as long as that's good. It's very simple to run through these deals. Okay, so I'm going to go through some cool stuff that I found in these reports, and hopefully you guys find it interesting too. Okay. So this is a 190-page document. I picked out about 5 pages, which I thought were important, where I thought you guys would be able to take a look. So here we have some forward progressing. This is just a general nationwide where John Burns believes single family rental yield will go over the next 4 years. Well, actually 3 years by now. So 2023, 2024, 2025. So this is just basically what you would make as a property owner after you pay your taxes, the yield owning a single family house. So what this is showing is in the future, there should be growth in the future of, and the main reason I wanted to bring this up is it eliminates the thought that you miss the boat when it comes to investing in single family houses. And this is contrary to what I said earlier, buying a single family house. We're not buying one single family house. This is contiguous houses. This is buying or developing 100 houses in one spot. So it's basically horizontal multifamily. So we wouldn't sell them unless the opportunity presented itself where the profit would just be completely crazy. We wouldn't be interested in selling these houses in one shot. It's basically a large community that we're putting together that we would rent, as it would be one rental portfolio. So this is not renting I do not recommend doing single family rental, owning scattered houses or a random house here and there. So this is large packages of houses that we're going to be talking about in this little segment. In the future, this is going to be just tied to expenses kind of settling as time goes on. We know that 2020, 2021, 2022 expenses were running up and rents weren't able to catch up in time. So we saw profits drop, as contrary to what you may see in the news that landlords crushed it. A lot of expenses ran up in the short period of time as well. So in the future, as expenses settle and rents continue to climb slightly, rental yield on single family houses or rental yield across the board should continue to grow. So in the future, we do not see any weakening of the rental business, we should say.
Listen to me. This way.
Yep. So and
Yeah.
I think, another point to Chris's, talk on single family homes versus rental communities. I think that the build to rent space is still very much in its early innings. As we continue to see people, value the flexibility of renting, not being tied down to a house, not having liquidity, stuck in a house. These build to rent communities are ramping up, and actually occupancy on build to rent has begun to mirror those of multifamily. So, although you look at it and you say, wow, it's 98 homes, it really isn't. It's 98 units that are a little bit larger. They're typically brand new in this environment. And, now each tenant has their own entrance. So opposed to being in a fourplex or detached home, some tenants and their families and pets, they very much value being in their own unit. So we think this trend is here to stay. I think it's going to be very, very interesting to see where this sector goes in the next 10 years. A lot of people are saying it very much reminds them of self-storage about 15 years ago. Self-storage historically in this country was owned by mom and pop operators who, had a few assets near where they lived, and they helped people rent lockers and storage for their items and their businesses. Over time, institutions started to see how strong of a business plan that was, how much demand there was. And now, if you look at the supply of that, institutions own the majority of the self-storage space. So build to rent is exciting. We think it's in the early innings. And, I would venture to say this sounds like self-storage 10 to 15 years ago. So we're excited about the space, the demographics nationally. And obviously, as we touched on, land costs coming down just make it an even more attractive entry point to get into this asset class.
Yeah, so like Alex said, the country as a whole is definitely going to be, or the future of the country, that being that there's such a tremendous population shift, one, and I think the idea of home ownership, because the idea of owning a home is usually an emotional purchase, right? People do it because they think they have to do it. But the idea of being a little bit more mobile, and I think the secret's getting out that it's not imperative to own a home. It really it really presents a huge void in the market for people who actually want to live in a house, but they don't want to own it. So what we're able to do with these assets is we're able to put a rent in front of somebody that is basically the same, if not a little bit better than a mortgage would be, and they don't have to come up with a down payment, and they know that our community will be forever a rental. So a fear that people get into when they rent a single family house is one day the owner will say, hey, I'm selling. That doesn't exist here. People are able to rent a house, raise a family, stay in one spot, pay their rent. And really, if they want to do the right thing with their money, if say they have the money for a down payment, they really want to do the right thing, you could put that same money in another income producing something. We're not going to go into where the absolute best place to put your money is, because it's generally different for everybody, but put your money into something that's income producing somewhere else and rent your own house. Typically winds up being a better financial decision once emotion is removed. So, all right, we didn't get into, I don't want to get too deep into that. We get into where to invest. So this is a wonderful chart, and people ask me all the time, what's the secret? Where to go? The truth is, there really is no secret. If you watch the news a little bit, I shouldn't say watch the news, I hate watching the news. If you read articles just a little bit, you're going to see where the trends are going. And you hear of all these markets constantly growing. And sometimes a little bit of time passes, you think you're too late. You'll see that there is some shift from current to future, which the Burns report, it'll show a little bit of a shift, like Nashville's at number 1, it'll be number 18. It still is on the top 20 list. But usually the areas that grew extremely rapidly will slow down a little bit. They'll get pushed down towards the bottom, and areas that have been growing at a decent pace will ramp up. So you'll see a lot of these are just going to change positions as time goes on. But this is basically it. I mean, these areas, or I should say MSAs, are the places that people are moving to for a whole variety of reasons. The reason that we like to focus on is jobs specifically. People move for, people move for taxes, people move through certain levels of emotion. They want better weather. We don't want to track that. We're not interested in people moving for weather, because the weather, for the most part, nationally, hasn't changed ever. Florida's always been hot. New York has always had its seasons. So that's, we want to track what's been changing, and jobs are probably the most important fact for us. Where jobs go, money goes. Where money goes, higher rent goes, and growth and appreciation goes. You'll see areas like Houston for a long time were flat, and now we see it's showing up on some pages as a future growth market. Rents were flat for a long time in Houston, and partly because the land is flat. When the land is flat, rents will be flat. When there's topography or water, typically there's growth, right? So I don't know if you guys could see my face, being that we're showing the screen, but when the land is flat and it's endless, if you look out a window and you see nothing but dirt, there's a good chance that real estate will remain fairly flat. This is actually a great lesson for anyone to know. And it's kind of a reason why you'll see New York City prices will always appreciate. Why is that? Because it can't get any bigger. Manhattan cannot get any larger. The boroughs cannot get any larger. There is no more dirt. We're just doing fill-ins. We're knocking things down, making things bigger. That will create growth within a market. There is limited space. Southeast Florida cannot get any larger, because if you go to the east, you hit an ocean. If you go to the west, you got swamp. If you go north, once you get north of Jupiter, the water gets cooler. Not too many people who put that together. But the reason that north of Jupiter will never be as popular as south of Jupiter is the state of Florida curves right at Jupiter, and the Gulf Stream starts to kick off into the Atlantic Ocean, and the water cools is much cooler north of Jupiter. So south of Jupiter, and once you get below Miami, you're out of land, right? So it can't get wider, can't go north, and can't go south. So this is the kind of barriers you want to look for. Denver, you got mountains, can't get any bigger. There is land to build in Denver, but Denver will hit a point where it just can't get any larger, and that's when the values really start to grow. And then you're looking at these major hubs like Orlando. If I'm sure for you guys on the call, if you ever been through Orlando Airport, it is unbelievable how much of a hub Orlando is, and it's just growing and growing and growing. But if you want, I would write these markets down. These markets are to be focused on, absolutely. Next page I had was 67. Okay, so this is just showing you rental growth through 2025. So we have, of course, Florida, Phoenix. And the reason I was saying before, if you read any articles, you see all these names popping up all over the place. These are the areas. This is the growth. This is the growth of the country. It's just going to head in this direction. There's not going to be any stopping it. And of course, you see a lot of Florida. Florida, I always had a small concern with Florida, just because all the benefits were always there of Florida. And it seems like it's finally making the turn. Alex and I talk about it all the time. I think the turn has happened, and the news is out, and people are just making the move, whether it be virtual work or, Florida's population has been growing literally for the past 100 years, with no blip, but I guess this is with no blip, but it's really starting to take off now. In the past 10 years, pre-COVID, Florida was actually fairly flat. Alex, if you had anything on any of these pages, you could chime in at any time.
Yeah, no, I think, what Chris noted about Florida, it is very interesting. I think COVID, as most people would imagine, continued to propel it. And there's a lack of, available land. So obviously just straightforward supply and demand sectors. Florida has continued to do very well. And then, yeah, you see a lot of markets on here that, were probably not talked about as much 20 years ago. Raleigh-Durham has been robust. Nashville, Dallas, Houston, these are great markets that the fundamentals are outpacing a lot of the larger markets that existed in this country 15, 20 years ago as primary markets. The shift is happening, and frankly, from us to institutional investors to economists to John Burns, they would probably all echo the same sentiment. So, this has continued to be part of our acquisition strategy. And, I think as time goes on and, pro-business states continue to move forward, there's going to be a lot of attractive opportunities and growth that exceeds the national average in a lot of these markets that are even more highlighted here in the map Chris pulled up.
Yeah, so this is definitely another, you want to take your cell phone out and shoot a picture of this screen. This map is a wonderful is a wonderful chart of where they think and we believe the future to go as far as rentals are concerned. You want to pay attention to what's red and what's green and what's dark green. So some of these economies, Phoenix, Florida, the Carolinas, Charlotte specifically, if you've ever been in Charlotte Airport, you would think you might be in JFK Airport. Some of these major hubs are really looking to take off. Some areas like Boise, Idaho, San Jose, these markets, they fluctuate. Boise, Boise's a new Boise kind of blew up quick during COVID. You have to, what this red means is it blew up too quick, and now they're going to have a problem with too much supply and not enough. There's not enough demand, too much supply, and the jobs couldn't keep up with the amount of people going there. And Florida just remains that dark green. And there's a small part of me that's like, should we get into Florida? Maybe not. I keep bouncing back and forth about Florida. It's probably all a bad decision. We probably should just get there. But when we see these, I'm happy to say that we own right here, Fayetteville. We have properties in Huntsville, and we'll be here tomorrow. So, you want to make sure that if you're buying, you're in one of these markets that's getting some attention. If you're in markets that aren't getting any attention, all real estate is not created equal, as I keep saying. So you will find yourself in a position where you're either decreasing in value or staying dead flat. If there isn't any attention, that means that no one's going there. And if people aren't going someplace continuously or growing population, you'll just notice that the prices remain flat. You buy a house for, you pay $100,000 a door, or you for a multifamily, or you buy a house for 500,000, 400,000, 300,000. In 10 years, you'll see it's 300,000. So effectively, you actually lost money. But again, Florida.
I agree with that, Chris. Yeah, Florida's been a great market. There's an extreme lack of affordability in the housing there. But then there's other levers to pull that make it a little more difficult. Property taxes are high, serious insurance issue there. If you have or plan on looking at assets in Florida, it's very easy to get excited about markets, job growth, home values. Insurance is something you can't control, and neither could your property manager. So that is a big number. That is a fixed cost in your underwriting that you're going to have to live with. So, Florida has some great things going for it, but that is an issue that, most people are talking about, but some people won't. So that is, kind of what's going on in Florida in our view. And, as Chris touched on, there's a lot of markets on here that are in green, that are growing, that are continue to outpace national growth. And we think a big part of that is median incomes driving into a lot of these markets. You look at Dallas, Nashville, Phoenix, you have extremely high paying jobs in these markets and continuing to come into these markets. You have national universities in all of these cities that are investing hundreds and billions of dollars in postgraduate programs. That's where we're shifting all of our focus. We're up in New York, we're not acquiring here. And I think this chart is just always a great fact check, frankly. You can look and say, why is this on the lower end of growth rate? Like, what should I be looking at? And I'm sure if you dig deep enough, you'll find the reason why. And the stats, we're looking at this today, so are the institutions. So, I don't think,
That's right.
I think this is just a great fact check, and, people should use it as a resource.
Yeah, you'll see like markets like Huntsville. And Alex, what was it? What was the term that we've heard on a market like Huntsville? It turns the corner as far as I guess the agencies, when they start to look at a market as a primary market as opposed to a secondary market.
That's correct. So
we
the
see it.
agencies, the way they look at some of these markets, or have in the past 30 years, they change that methodology, on the drop of a dime. And, and once they get comfortable with the market and it reaches a new threshold, they're then able to lend more accretively and higher leverage than they may have previously, which I think speaks to, why you want to be in a market. It's going to, kind of implement and, propel more acquisition activity, just given the metrics are going to improve. So yes, those are great things to focus on. They kind of turn the corner on what's to come and how people can transact there that they may not have 15 years ago.
Yeah, you'll see. I think one of the last calls when we will our recent batch of loans, the Huntsville market was on the radar to be the next to turn. So what happens is they make that turn, and all of a sudden, all the property values, all the commercial property values in Huntsville jump, because now everyone who goes to get a loan in the Huntsville market is all of a sudden borrowing at 50 basis points cheaper than if you were to be borrowing in, call a random market, a random secondary market. Even Fayetteville would be considered a secondary market. So we're borrowing at 50 basis points higher than if we were buying something at Fort Lauderdale or Fort Myers. So when it makes that turn, or Fayetteville makes the turn as well, all of a sudden, all the commercial property values jump in the area. So you want to be owning in the markets that are going to be making that turn. Let's see, I had 73 is the next interesting page to show you guys, and then one more after that, and I think that's it. Oh, so, and we talk about this all the time. So what happened in 2008 with rents? So what happened with home values? What happened with multifamily values? Because we believe that history repeats itself. And usually what happened before will happen again, usually. So there's always a little bit of a difference. Trends are definitely shifting a little bit differently now. People are moving into certain areas quicker. But we just take a quick glance at this. We take this with a grain of salt because, like I said, things do change from the past to the current, but we try to find trends. This is just a chart of what happened during the Great Recession, 2008, to rents in certain markets around the country. So we could see that other than Phoenix, we knew Phoenix took a bath during the Great Recession as far as rents are concerned. Phoenix took a bath. But if we take anything above, say, Phoenix, Atlanta took a little bit of a bath, Raleigh, Durham, 2.3% negative. I can tell you a big difference now between 2008 and now, and this is why we have to take this chart with a grain of salt. Raleigh, Durham is getting billions of dollars of investment. So that's why you're seeing it on all the top charts of what's going to come in the next couple of years. And Phoenix is a funny market. The economy is extremely diverse, right? So when you don't want to get caught up investing in a market that is heavily reliant upon one industry, right? So if we go to Texas, we're not going to go to a market that only relies on oil. Like, oh, this is a great oil town. Like, no, the political climate changes a little bit, and all of a sudden, no one's there anymore, and now it's a ghost town. So Phoenix is almost, New York City, calling New York City the Mecca, right? A bank goes out of business, the high rise is occupied in 15 minutes by somebody else. You want to get into markets like that. The reason we can't invest in New York is the rental laws are actually are completely terrible, and the only way you can invest in New York is if you have the absolute best real estate that exists. That's the one way around. This is getting off topic, but the one way around terrible rental laws, terrible landlord-tenant laws. The only way to escape that is to have the best real estate in that market. So if you have ultra high-end multifamily or ultra high-end apartments in Manhattan, you have a chance to escape that. It's just a different level of person. They don't want to lose that spot. Anything less than serving the absolute best in these areas, you're susceptible to just a terrible climate that just doesn't want to help you at all and just has no problem with you going out of business. But this is something good just to note. Again, take these markets with sort of grain of salt. But what's also interesting is the absolute worst is 4%. On average, you would say the worst is 1%. If you take the worst housing crisis that we've seen in our life and we lost 1%, rents went down by 1%, I'll take it. I'll be in that business. If you say that you get into a business and the worst thing that happened in our life in the past, which would be considered some of the worst real estate downturn we've seen, most markets at the worst lost 1%. I'll take that bet. And then you see less than 1%, and then just this is not really growth. It's basically flat. So very interesting page. Some people get very concerned about what the future might look like, but rents for the most part remain fairly stable. I had one more page. Let's see, what was this? Single family rents across the 20 SFR markets have risen 6 to 32% since the start of the pandemic in March 2020. Yeah, so this is just a chart showing effective rent growth since 2020. So again, so Phoenix being the fastest growth. Oh, I didn't finish on Phoenix. So Phoenix have an extremely diverse economy. The one thing that makes us nervous about Phoenix and something that we look at in our markets is we want to compare what people earn versus what they pay in rent. And Phoenix touches almost 50% in some markets. So people spend up to 50% of what they earn on their rent. Simply not sustainable. I know specifically the markets there. We're in Fayetteville, we're at a quarter of people's income. Average the household income, where our rents are at a quarter of what the average household income is. So we feel like we're in a very safe place there. So this is the grain of salt that you want to add to the last. So when people are in a market where they're spending almost 50% of what they earn on rent, that would push you to pull back maybe a little bit. And it's all calculation. A million things are taken into account here. But again, just showing you different charts of different metrics. All right. So if you guys have any questions, Alex, if you have anything to add, just go quick call. Hopefully you guys got something out of it. Steal some markets from us, steal some of our research, do it on your own, contact us, whatever you want to do is cool with us.
No, I appreciate that. I think a lot of what Chris said is extremely valuable. It's, we're not on the sideline right now. We're still having conversations with large, credible national brokers that represent, some of the largest publicly traded institutions in the space. So we definitely encourage anyone to reach out that may be interested in housing or build for rent, what that space looks like, what it's expected to look like, who's the major players in it, whether it be yourself, your friends. We're excited to be in front of this topic, and as always, happy to touch base with more introductions.
Yeah, guys. All right. All right, sounds good. So, we'll see you next Monday.
Great. Thanks, guys.
All right, take care. All right, Mike, we could end it, right?